That's really interesting. We've seen a combination. Sometimes families that want to hang on to the investment and end up as the majority shareholder and have it as a business. But normally speaking, they're not that different from other institutions in wanting to get their return on capital in a decent time frame. But the great beauty is that they do have patient capital, so that if it's going to take 10 years and not 7 years, they can hang on in there. They're not under pressure to have those returns.
Well, welcome back to the hot seat. Today, I'm delighted to be speaking to Sally Tennant, who's the founding partner of Acorn Capital Advisors. Welcome, Sally.
Thank you. It's a pleasure to be here.
So we're going to talk today about private equity for family offices. But before we get into the meat of our discussion, it'd be great to hear a little bit more about Acorn Capital Advisors for those who aren't familiar with the business.
Thank you, David. Well, Acorn Capital Advisors was established as we saw the gap in the market for truly independent advisors who were experienced practitioners. Having stepped down from running a private bank, Timeball Benton, 4 or 5 years ago, I was surprised, as was my partner Diane, by the number of people approaching us, family offices, high net worth individuals, ex-clients, to ask what they should be doing, whom they should trust, what investments were good. And at first, I would give away all that information truly, freely and happily. And then I realized that actually there was a large demand. So that was why Acorn Capital Advisors was established.
Okay, terrific. And we're going to look today at private equity for family offices. It's a very dynamically growing area. There's huge demand from family offices, I guess, because of the hunt for returns, looking to try and beat returns available in listed markets. Perhaps you could give us a sense of some of the trends you think for private equity from the family office sector.
Delighted to. Yes, you're absolutely right. There has been a huge demand and increase in private equity exposure amongst family offices. Over the last 10 years, the average weighting of private equity, if you look at most of the reports, has moved from 5 or 6% to 15 or 20%. And the reason behind that is clear that the returns in this low interest rate environment, people are looking for growth. Private equity returns are slightly less correlated with public equity returns. And there are a lot of new businesses and the market has grown. So family offices have been attracted to private equity.
And so for family offices, getting access to the top managers is obviously a key part of the equation. And what's your advice to family offices who are looking at this sector and analysing the managers and trying to find the very best of breed?
Well, you're spot on. Access to the best managers is really key. And it's particularly key right now because there is a trend amongst family offices to want to invest directly and do some co-investments. And actually, unless you have access and invested in the big funds, that's really hard to do. So what we've advised family offices who are, let's say, new to investing in private equity, have been established more recently and haven't been going for 20 years, is to have a combination of in-house resources and working with some of the best banks and private equity managers to complement and be able to get access to those funds.
Okay, because avoiding the bottom quintile is a key part, I suppose, of generating the performance. It's not just to allocate to the asset class, it's to really try and pick some of the winners. And that has a serious implication for returns, I'd imagine your analysis shows.
Absolutely, spot on. I mean, according to Burgess, over the last 20 years, there is a 20.7% gap between the third quartile, not even the fourth, and the top quartile. So access is key to the best managers in order to have the performance, to achieve the performance.
And on that resources point, I mean, how do you help family offices understand the amount of resources they need to help analyse deal flow, do the necessary due diligence? You know, you mentioned before that that is a real challenge for family offices, where banks might be staffed with large teams looking at this deal flow. How do you approach that in a family office setting?
So I think that a family office offers private equity specialists a really interesting balance in their lifestyle in terms of being able to attract the talent. And I think that the ability to be able to focus purely on the private equity investments, not having to raise money all the time, not having to search for the direct deals, is attractive in terms of being able to attract the talent. But your question is more around how much talent and how do you need all those resources? And that goes back to what I said about working in a combination of in-house and outside resources. What we've also seen recently is actually family offices clubbing together with their resources to look at deals to expand the due diligence resource that is required. So we would say that on average, you need a team of between 6 and 10 people to be able to buy 6 or 7 funds a year and do 2 or 3 co-investments, give or take. And that clearly doesn't compete with some of the big players who've got tens, if not hundreds, of people doing due diligence. So it's combining working with the best in the industry and building your own expertise.
Okay, thanks. And on the portfolio concentration side with private equity, you know, what's your view as to the weightings that families put on different parts of the asset allocation, and within private equity, what weightings they put on different investments?
So I think there's a number of facets to that question, because part of it is, you be at the VC early stage growth? Should you be doing further down the life cycle of private equity with buyouts and distressed? So there's a decision that you've got to make as to where you want to be on the risk curve. And then we advise our clients to try and not be too clever. When you're taking a 10-year view, you can't predict the economic cycle. So we think that actually the most important thing is to be disciplined about building a portfolio of managers in different sectors, different vintages, and different geographies to give you that diversification.
And but the point on the diversification side is that it might differ from an approach they have on public markets. So it's going to be requiring a different approach to investment, would you say? Well,
we think sort of rather counterintuitively to most people, that actually the diversification that people should have in their private in their overall portfolio should come predominantly from the public markets and from your core equity exposure of our funds. Where we think differently is around direct investments, where we see the most successful family offices, the most successful investors actually focus on a particular area and/or expertise.
Okay, and you mentioned before family offices coming to this sector afresh. They're looking to understand, you know, performance, cash flows, liquidity. How do you help them navigate this for the first time and set themselves up to understand the sector in the most effective way?
It's a really important issue. Understanding performance, understanding fees is a bit of a minefield. The statistics show that the difference on average in the States with private equity firms between the gross and the net fees can be up to 7 or 8% in early stage PE. That's huge. So you really need to understand, when it comes to fees, exactly what's included and what isn't included in those fees. and therefore having good due diligence and thorough analysis is pretty important. And we encourage our clients to really challenge back about what fees are included or not, such as marketing fees, raising money fees. Why should that be charged to the fund? Why shouldn't it be? So that's on the fee side, and obviously high fees impact performance. But when it comes to measuring private equity performance, is very different from the public markets. As we know, in the public markets, you can measure performance on a daily basis or hourly if you want. You know the price in which you went in and the price in which you leave. In private equity, it's very different because you commit the money, you don't know when it's going to be invested, and how you measure the performance. I mean, broadly speaking, there are two key ways that most people measure performance, and one is the IRR, the internal rate of return, and the other is a multiple of invested capital. Now, neither is perfect. The IRR assumes the money goes in at a similar rate, similar time frame, and the multiple money does not take into account the length of period of the investment. But basically, you need to look at both. And with experience, you learn to unpack those numbers and really understand what the drivers of performance are. If I could, David, add that there is something that's pretty important for a family office going into private equity who are not used to the fact that it takes a long time before the performance comes through. In the first 3 years, you're investing money before you get any back, as well known as the J curve. And it can be very unnerving for a family during those first few years that they don't see the returns, particularly if something like 2008 happens and they kind of feel, oh my goodness, the world's coming to an end, should I continue? And actually, that's not necessarily the right thing to do. The other thing that's quite interesting, if you look at the annual performance of a private equity investment against its peers, it's really quite scary that it can move from being a top performer to the next year being a really poor performer. So what you need is that longer term time frame. And we say around 6 years, and in fact, Cambridge Associates reckon on average it's 8 years to truly be able to assess the long-term performance.
Okay, and you mentioned before about a 10-year time horizon as well. So this is all very long-term money in order to generate those returns that people are looking for. But I presume that they've got income and cash flows from other sources, whether that's real estate, whether there's dividends being paid. So it's about looking at the portfolio holistically, I suppose, and this being a driver of long-term returns that you're not accessing for a good period yet. Is that fair to say?
I think it is absolutely fair to say, but it is something that you have to be really aware of at the beginning, that this money is not going to be liquid. So you have to think in terms of a buffer to make sure that if your income requirements are going to change over that 7 to 10 year period, you can afford to have that money locked away, because it's the last thing that you want to do is have to sell a portfolio exactly when the markets are down, which most famous of all was the Harvard Endowment in 2008, had to actually raise 2.5 billion to meet their calls. So it's super important that families think through what their cash requirements are, and we encourage our clients to ensure that part of their resources that they have is that they build themselves or work with their third-party partner to have an illiquidity model, so that they model their funds, they model what they have, and they model it for things that are going well, and they model it if things are not going to go well. And what's great about that is it means that you can have a credit line, you can make sure you've got a cash buffer, so that if things deteriorate, you don't have to sell at the bottom of the market.
And how do family offices who are co-investing, you mentioned before about families clubbing together, actually achieve the successful exits? Who might they go and sell on to, or how do you advise them to look at the options when they're trying to actually realise value that they've built up in an asset?
That's really interesting. We've seen a combination. Sometimes families that want to hang on to the investment and end up as the majority shareholder and have it as a business. But normally speaking, they're not that different from other institutions in wanting to get their return on capital in a decent time frame. But the great beauty is that they do have patient capital, so that if it's going to take 10 years and not 7 years, they can hang on in there. They're not under pressure to have those returns.
And finally, Sally, the ESG and impact investing is now often incorporated into investment strategy more often than not, and it's written about so much in the press, and that's equally true in the family office sector. And how do you find family offices incorporating ESG and impact into private equity investments they're seeking to make?
I think family offices are leading the way in ESG and impact in the private equity space, because they're bringing the disciplines in the long only world and encouraging the managers to embrace ESG. So private equity on average has been behind public equities in embracing ESG, and the managers ensuring that the companies and funds they're investing in are monitoring and encouraging good ESG practices. And family offices have been leading the way in encouraging that, which I think is great.
So finally, Sally, just bringing it all together, as well as the right tools and teams, what mindset do you need to be successful in this area?
The most successful family offices have the 3 Ps in common: perspicacity, patience, and prudence. Perspicacity, to back their judgment, their insights, and make a decision. The patience to see it through over a long-term time frame, and the prudence to do some risk modeling and ensure that they're ready for when the times aren't that good.
And is there any area in which a family office has a competitive advantage over other institutions?
So we think that families who have a business or a passion for a particular sector and can bring expertise have a huge advantage over a normal institution. If they're entrepreneurs, they are attractive to other businesses who like the idea that they'll get more than capital, they'll get intellectual alpha, support, and insights into that sector. And that's one of the reasons why successful direct private equity family office investors often focus in one particular area. They then become part of an ecosystem and the go-to investor for that particular segment.
Okay, well, thank you for talking to me today. Really interesting conversation. We also look forward to sharing an article you've written on this subject. So thanks for talking to me today.